Have you ever felt the subtle tug of the market's current, pulling you to act, to buy, to sell, convinced that this moment is the one you must seize? That persistent whisper, an almost instinctual urge to decipher the market's next breath, can be an exhausting companion on the path to financial mastery. It's a shared burden, a silent ache many carry, feeling overwhelmed by the sheer volume of conflicting information and the noise that promises quick insights, yet often leaves us more confused than before. This deep-seated fear of making costly investment mistakes, the anxiety of not knowing how to effectively translate theoretical knowledge into real-world action, often stems from something far more subtle than market complexity itself. What if much of this struggle isn't about the market's external forces, but about the hidden currents within our own minds? What if the very instincts we trust to guide us towards astute market timing are, in fact, silently sabotaging our journey towards sustainable wealth accumulation? Today, we will gently pull back the veil on this inner landscape. We will explore not just the market's fluctuations, but the subtle, internal biases that often dictate our reactions to them. Our journey is one of demystification, aiming to uncover 3 hidden biases in market timing. Biases that whisper illusions of control and certainty, yet often lead us astray from the calm waters of informed decision-making. Our guide will be the steady compass of data-driven truth, drawing wisdom distilled from decades of market observation and the profound insights of giants like Benjamin Graham. Graham, the revered father of value investing, once reminded us with quiet conviction that the investor's chief problem, and even his worst enemy, is likely to be himself. This profound truth echoes through the decades, a gentle yet firm reminder that true mastery begins with understanding our own cognitive landscape. He wasn't speaking of a lack of intelligence, but of the very human tendencies that cloud our judgment when faced with the market's ever-present siren song. Imagine the market not as a predictable clockwork mechanism, but as a vast, shimmering ocean, its surface constantly shifting, its depths holding unseen currents. We, as investors, often stand on the shore, trying to predict every wave, every ripple, every shift in the tide. We believe we can time our entry and exit perfectly, like a seasoned sailor navigating a storm. Yet, often, we are caught by unexpected swells, or we miss the steady, deep currents that truly carry the ship of wealth forward. The biases we carry are like invisible anchors, subtly dragging us off course, even when the stars seem perfectly aligned, even when our intentions are pure. Beyond the headlines, what's really driving the market, and more importantly, what's driving our reaction to it? Let us begin to uncover these hidden truths, not with judgment, but with the quiet courage to see ourselves clearly and to chart a more deliberate course toward financial independence. Often, we find ourselves clinging to a specific memory, a precise number, the price at which we first bought a share. This entry point can quietly become a financial anchor, holding us in place even when market currents shift dramatically. It's a subtle, almost unconscious fear of acknowledging a less than perfect initial decision, a silent inadequacy that whispers, if I sell now, I've truly lost. This desire to validate past choices rather than facing present reality can tether us to losing positions or blind us to fresh opportunities. This is the anchoring trap, a pervasive distortion convincing us that past price levels inherently dictate future good or bad entry points. We mistakenly believe a stock must return to an old high, or that a deep dip must be the perfect moment to buy, simply because it's lower. Yet, this anchors our decisions to irrelevant historical data, ignoring the living truth of current fundamental value, evolving market dynamics, or a company's true economic moat. The market, in its profound indifference, simply does not care about your cost basis. It only reflects present and future expectations. Rigorous data analysis shatters this expectation with quiet certainty. Studies consistently reveal that investors who anchor their decisions to previous price points, rather than re-evaluating based on ongoing fundamental analysis, consistently underperform. To genuinely discern market signals, we can embrace a 3-step value investing technique. First, practice a clean slate valuation. Regularly re-evaluate investments as if buying them today, ignoring past entry prices. Second, ask, what has fundamentally changed? Third, use a pre-mortem analysis. Imagine the investment failing. What anchoring biases might have led you there? Consider the market as a constantly shifting river. If you anchor your boat to a fixed point on the bank where you first launched, you will inevitably miss the true flow, the deeper currents carrying wealth forward. True navigation demands intimacy with the river's entire ecosystem, adapting to its changes, rather than merely remembering where you first dipped your oar. Are we truly embracing the river's living movement, or are we held captive by the ghost of a past moment? There is a compelling mirage in the market, a shimmering illusion born from the relentless flow of headlines and the constant drumbeat of new information. It's a powerful emotional current, pulling us to chase the latest trends, to act impulsively, driven by a deep-seated fear of missing out. This recency bias causes us to disproportionately disproportionately weigh recent market performance or news, often leading to decisions made in haste, buying at peaks and selling at troughs. It's a cycle fueled by a wounded financial confidence, constantly seeking external validation in the market's fleeting moments. This is the distortion, the myth that recent market trends or economic indicators are the most reliable predictors of future performance. We become fixated on the last quarter's earnings, yesterday's inflation report, or the past week's market movement, believing these surface ripples tell the whole story. This overemphasis on the immediate past blinds us to the deeper, slow occurrence of long-term cycles, fundamental shifts, and the quiet, persistent power of compounding. We forget that the most significant truths often unfold over years, not days. Quantitative analysis consistently shatters this expectation. Data reveals, with unwavering clarity, that portfolios heavily influenced by recency bias consistently underperform. The market's true signals reside not in the fleeting surface ripples of daily news, but in the deeper, more enduring currents of intrinsic value and long-term trends. To move beyond this mirage, we can adopt a symbolic exercise, temporal bracketing. When analyzing any market event or stock, consciously define the time horizon of the data you're considering. Then, deliberately expand the bracket to 5, 10, even 20 years. This practice forces a broader perspective, revealing the true, often subtle, impact of compounding that the immediate past obscures. Imagine the market as a vast, ancient ocean. To fixate only on the last wave to hit the shore, believing it dictates the ocean's entire being, is a profound mistake for those seeking sustainable wealth. True navigation requires understanding the deep ocean currents, the distant weather patterns, and the accumulated wisdom of historical navigation. It demands that we look beyond the immediate, beyond the recent, and truly see the expansive, enduring forces at play. Are we truly seeing the ocean, or only the last breaking wave? There is a subtle, yet deeply entrenched error in our thinking, one that often masquerades as conviction, confirmation bias. We, as investors, often unconsciously seek out and interpret market data in a way that confirms our pre-existing beliefs about market direction or a specific stock's timing. This isn't true conviction. It's an insidious form of self-deception, quietly hiding inadequate due diligence and an inflexibility to truly new market data. At its root lies a profound, often unacknowledged fear of being wrong, a vulnerability that makes us blind to truths that challenge our comfort. This leads to a common distortion about investment gurus, the myth that successful investors possess a unique, almost magical intuition for market timing. Yet, if we truly deconstruct their process, we find that their intuition is often a disciplined, rigorous practice of actively seeking disconfirming evidence, of challenging their own hypotheses with quantitative analysis. This is precisely the practice that confirmation bias actively sabotages, trapping us in an echo chamber of our own making, hearing only what we wish to hear. Data clearly shatters the expectation that a closed mind leads to success. It reveals, time and again, that investors who actively seek out contradictory evidence and rigorously challenge their own hypotheses make far more robust and profitable long-term decisions. This isn't just a strategy, it's a core tenet of critical theory in finance, a recognition that truth emerges from relentless questioning, not from comfortable affirmation. To discern genuine market truths, we can adopt a three-step critical thinking technique, the devil's advocate protocol. Before making a significant market timing decision, consciously list 3 strong, data-backed arguments against your chosen timing. Actively seek out data that specifically refutes your initial hypothesis. Finally, share your arguments and counter-arguments with a trusted, objective peer for their unbiased review. Consider the market as a complex courtroom, a place where profound truths are revealed through the careful examination of all evidence. If you only present testimony that supports your case, ignoring all contradictory evidence, you are not seeking justice or truth. Instead, you are orchestrating a biased verdict against your own portfolio, leading to a financial outcome based on delusion, not data. Are we truly seeking the whole truth, or merely the comforting echo of our own beliefs? Our brains, in their profound complexity, are wired for stories, not for the cold, hard logic of spreadsheets. This fundamental truth gives rise to the narrative fallacy, a powerful cognitive factor that often sabotages our ability to critically analyze financial data. We find ourselves drawn to compelling market tales, whispers of this time is different, or the allure of the next big thing, prioritizing these narratives over the dispassionate truth of the data. This severely hinders objective market timing decisions, often leaving us with a philosophical wound when our conviction, based on a captivating story, clashes with unforgiving market reality. This is the common distortion, the myth that a strong, widely accepted market narrative, whether its tech is unstoppable or inflation is transitory, is a reliable signal for market entry or exit. These narratives often become most potent, most seductive, precisely at market inflection points, when they are, in fact, most dangerous. They distort our clear understanding of intrinsic value, painting a picture that what feels right, feels logical, yet lacks the solid foundation of verifiable numbers. History is littered with shattered expectations born from these emotionally resonant market narratives. Consider the dot-com bubble, a stark reminder of narrative's immense power over reason. Investors, caught in the intoxicating story of a new economy, ignored all forensic accounting and data analysis that would have revealed the underlying fragility. It was a time when compelling tales led countless individuals astray, while dispassionate numbers whispered a different, more sobering truth. The wisdom of figures like Jesse Livermore offers a powerful counter-narrative, revealing the critical importance of independent thought and data-driven analysis over market sentiment. He understood that market stories were often just noise, distractions from the genuine signals. For Livermore, true opportunity lay in understanding price action and volume, devoid of narrative bias, reflecting principles of quantitative analysis. He sought the underlying rhythm, not just the catchy tune. Imagine the market as a grand, intricate symphony. While the immediate melody, the compelling narrative, captures our attention, the true power and structure, the profound beauty, lie in the harmony, the rhythm, and the counterpoint, the underlying data. To ignore the entire score for the catchiest tune leads inevitably to a discordant portfolio and missed opportunities for long-term wealth. Are we listening to the full symphony, or merely swayed by a captivating, yet potentially misleading, melody? There is an error, often mistaken for decisiveness, that whispers a dangerous illusion: overconfidence bias. Investors, especially after a few successful trades, often overestimate their ability to predict market movements or identify perfect timing windows. This isn't true decisiveness. It's a profound illusion of control that leads to insufficient due diligence, excessive risk-taking, and ultimately a wounded sense of decision-making autonomy from repeated failures. This bias convinces us we can beat the market's clock, that our intuition is superior to its vast, impersonal forces. This leads to a common distortion about active management, the myth that constant trading and diligent market timing equate to superior returns. Often, this frenetic activity is merely a symptom of overconfidence, leading to higher transaction costs, tax inefficiencies, and a dangerous lack of focus on fundamental analysis. Such an approach, far from building wealth, often erodes it. Rigorous quantitative studies consistently shatter this expectation. The data demonstrates, with unwavering clarity, that very few active managers or individual investors consistently outperform the market after accounting for fees and taxes. This underperformance is primarily due to the immense difficulty of overcoming transaction costs and, crucially, our own behavioral biases like overconfidence. This truth stands as a powerful critique, not of the market itself, but of our human tendency to believe we are special exceptions to its rules. To navigate this, we draw wisdom from Daniel Kahneman's asterisk thinking, fast and slow asterisk, understanding the interplay between our intuitive system, one, and analytical system to thinking. Implement a mandatory cooling off period for any significant market timing decision. This simple yet powerful practice forces system 2 to engage, to critically evaluate the impulsive system 1 urge, thereby enhancing our critical market analysis. It's an act of self-compassion, allowing reason to temper impulse. Consider the market as a vast, intricate clockwork mechanism. Believing you can precisely adjust every tiny gear by hand, speeding it up or slowing it down to your will, is an act of profound hubris. True mastery lies not in such futile intervention, but in understanding its fundamental principles, embracing the long-term compounding effect, and allowing it to run its course. It is about trusting the enduring mechanism, rather than trying to force its timing through overconfident intervention. Are we truly working with the market's rhythm, or are we trying to impose our own, often flawed, timing upon it? We have journeyed together through the subtle, often unseen currents that influence our market timing decisions. We've unmasked the anchoring trap, that quiet fear tethering us to past prices, the recency bias, which blinds us with yesterday's news, the confirmation bias echo chamber, where we filter truth to fit our beliefs, the narrative fallacy, where compelling stories overpower cold data, and finally, the illusion of control, that overconfidence telling us we can beat the market's clock. These are not mere academic concepts, they are the hidden architects of frustration, the silent saboteurs of sustainable wealth. They are the wounds that whisper of inadequacy, the unfulfilled longing for clarity amidst the noise. But understanding these biases is not an end, it is a profound beginning. It is the first step towards healing the fractured connection between our ambition and our execution. True, sustainable wealth is not built by frantically chasing market fluctuations, but by a disciplined, data-driven strategy and an unwavering emotional resilience. It is grounded in the timeless principles of value investing, in the quiet strength of intrinsic value, and in the profound, patient power of long-term compounding. We must shift from reactive speculation, driven by fear or greed, to proactive, principle-based investing, rooted in enduring truth. Consider the profound simplicity of Warren Buffett's timeless philosophy. Our favorite holding period is forever. This isn't just a catchy phrase. It's a testament to the futility of short-term timing and the immense power of patient, value-driven wealth creation. It invites us to see our investments not as fleeting transactions, but as enduring partnerships, like the nurturing of a deeply rooted tree that grows stronger with each passing season. As a symbolic practice, I invite you to pause, close your eyes, and imagine your investment portfolio not as a collection of tickers, but as a garden. Now, walk through this garden and identify any plants that you are tending not because they are healthy, fruitful, or growing, but simply because you planted them a long time ago, or because a compelling story once convinced you they would bloom instantly. Are you holding onto them out of habit, or out of a genuine, data-backed belief in their future? This is an invitation to cultivate a timeless investment mindset, one that embraces the deep, slow rhythms of the market, rather than its fleeting surface storms. It is a call to inner healing, to reclaim your autonomy from the tyranny of external noise and internal biases. Don't just invest, understand the why behind every decision. Challenge the consensus. Find your edge. Will you allow the hidden biases to continue dictating your financial destiny, or will you choose the path of data-driven truth and patient, intentional wealth creation?